Well, yes, it is. I mean, we're seeing the second and third largest Greek banks merging now. We've been anticipating this move for a number of years, and it has now come. So if you're a smaller Greek bank now, you would want to merge with another one to attain this bulk and size that is very important now in this environment.
So this is a good thing, is it, as we're hearing officials there argue?
Yes, absolutely. And it does also allow the banks to access capital markets in a much more effective way, funding and capital markets. And we're seeing this already with actually both Eurobank and Alpha, the merged entity raising capital with the participation also of Qatari funds. So this is very important.
Given the...
And especially for mid-sized European banks in troubled countries or countries whose sovereign is in doubt now, I think they could benefit significantly from merging and attaining this bulk and size, which is important, realizing the synergies and also attracting capital. And this indeed could be a way for the private sector to deal with this instead of let's say, the public sector having to inject capital or manage the situation.
So whereabouts could we see?
Mid-sized Italian banks, for example, mid-sized Spanish banks could do with more bulk. Those would be a couple of examples. And in Greece, like we said earlier, we'll probably see a domino effect, a chain reaction of M&A. But to what the agreement, the rollover and debt exchange agreement that has been made between Greece.
What does that mean for the accuracy of the valuation?
Well, in other words, what they have done is they have brought down the valuations by around 21%. So instead of holding the bonds at par, they hold them now 21%. There's more to go if one were to mark it down to market. But the assumption, the underlying assumption is that Greece will not default, and that's what the accountant. What's really important about banks and the markets, of course, is confidence. And confidence was shaken in the beginning of August by the US downgrade, by the situation in the Eurozone, doubts about that. And as a result, there were fears that the money markets would shut down, like we saw after the collapse of Lehman Brothers. But now confidence is improving, and that's also what is leading this rally in the banks. Those are all votes of confidence in European banks. Valuations are low, so we're talking about maybe 0.6, 0.7 times tangible book value for the European sector. For the Greek banks, which are much more troubled, of course, they're trading at 0.3, not necessarily, not solvency, but the question is whether the banks in certain countries can continue operating with the current business models. So a lot is changing. The sovereign is putting a lot of pressure, have significant reliance on US dollar funding, money market short-term funding, and that was also one of the implications of the Lehman collapse, as the banks had to shorten their liability, the terms. And this is not a structural issue necessarily. Once confidence returns, the banks should be able to term out their funding again. So it's all